thanks very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the most pressing market questions for 2026. We'll debate them with the investment committee. Joining me for the hour today, Joe Terranova, Liz Thomas, Steve Weiss, Josh Brown along in just a moment. We will check the markets here as we wind down the calendar. We are green across the board. But I said we're going to investigate the key questions for stocks in 2026. Which we've listed as such, and I think you'll agree, and we'll debate whether we've missed some of them or there are more pressing questions too. Can the AI trade get beyond the bubble banter? That's number one. Is the broadening trend durable? Right? That's what we're hearing a lot about. And can the rally run without rate cuts? Critical questions, Joe. Are those the three most pressing questions? Did we leave something out?
No, I think we have all three of them. I think the most important one is the broadening trend durable? To me, that is most important. If you think about coming into the fourth quarter, a quarter in which the S&P is 3% higher, I don't think very many people expected that healthcare would be up 11% and outperform the other 10 major S&P sectors by 8%. So I think what has happened is the personality of this market, it's becoming more discerning. It's becoming more discerning from the standpoint looking into 2026 and realizing there probably might be more rental opportunities than long-term anchoring in one particular investment theme. I think the market's going to rotate to a lot of different places, and that implies you're going to need, Scott, the 493 to participate. You cannot just rely on 7 individual stocks. You cannot rely on the AI halo to really lead the market higher. So I think that's what's going to be most critical for us. Real quick on AI, I think the market's doing a really good job in its behavior of recognizing when valuation, positioning, and sentiment gets to an extreme as it relates to that AI halo and correcting that. And I think we just witnessed that over the last 10 days.
You're almost back at 6,900. Liz, the tail of the tape, if you want to call it that, looks like this for 2025 for the majors. It's been a good year, obviously. S&P up 17%, we'll call it that. Dow good for about 13.5. NASDAQ 21.5 speaks to what has driven this market from the outset. And then the Russell 2000 has done quite well, 15% to the upside there. Liz, what about the questions that we ask? Are those the most important for investors to consider when they think about what stocks can do in the new year?
I think they are the most important. Joe covered the broadening trend, and I would agree with a lot of what he said, so I'll take a couple of the other ones. Can the AI trade get beyond the bubble banter? I think the fact that we're all worried about the bubble banter, the bad thing rarely happens when we're all talking about it happening. So I think it can get beyond the bubble banter. The one thing that I would sort of counteract to Joe's point is that I think we do need the AI enthusiasm for 2026 to actually look good. We do need the AI enthusiasm for the broadening out trade to remain because it's so important to sentiment. And that broadening out trade, in my opinion, relies a lot on the idea that AI will start to have productivity gains in other sectors. Other places in the economy will benefit from it. And CapEx can continue not just in AI, but just generally because the economy is durable and because productivity and growth are expected to reaccelerate in 2026. So we need it for sentiment. We need it for investor sentiment and economic sentiment. But I agree that it may not be the leader in the clubhouse as far as returns go next year.
That sounds right to me. What do you think?
Well, I think, first of all, I think one of the most important questions you didn't mention, who's going to be the next Fed chair and what's going to happen at that first meeting. Because economic policy is what ultimately controls the market.
Well, it's inherent in can the rally run without rate cuts? I mean, because whoever the next chair is going to be perceived to have a cutting bias. Like, you don't have to be a rocket scientist to figure that out.
No, that's absolutely true. He's made that clear. But it's going to be, will the market, after that first Fed meeting, if there is a press conference, we don't know if they'll continue to follow that, will the market have confidence in that person? So that's going to be a critical question. We got till mid-year. Even when they name, we know who they're going to name. Market said, okay, we like all 4. We're okay. Going back to your question, look, AI, it doesn't have to continue, to Liz's point, with what we saw in the first 9 months of the year, first 8 months, but it's still got to be a relevant trade to the upside. Because if it's not, it's still a very large portion of the indices, and it's still very important, that will bring down the whole market.
Liz's point is like it's only a big part of the indices, it's a big part of the economy, it's a big part of the narrative, it's a big part of sentiment, it's kind of the biggest part of everything.
But there's a difference between the market and the economy, and they're not always reflecting one another. So my view is it will continue to be a big part of the economy, whether it's part of the market or not. I think it will be. I think the AI trade's going to continue. I think there are more landmines, frankly, on the private side than in the public side. But OpenAI, even though it's a private company, it's sort of is regarded as a public company. So if they have major issues, which is a possibility, then I think you'd see the AI trade collapse. But the base case, my base case is you still want to be in those stocks in the Mag 7.
So Josh, we laid the questions out as we see them. We gave you the tail of the tape on where we enter 26. UBS says equities have further room to rally, and they list the obvious reasons. The current environment of solid economic growth, healthy corporate earnings, lower interest rates, and structural innovation drivers means investors can still add exposure to equity markets. So let's get your opinion here.
Well, I think we already have the answers to both questions. And I think this year has really revealed a lot about these huge misconceptions people have about how the stock market actually works. In the first half of the year, all the bears, even like the newsletter writers, the podcasters, people who don't actually manage money, the talkers, the big thing that they told us all, they warned us, they pounded the table, if anything happens to these AI stocks, you're all dead. Remember? That was the thing. Well, none of these AI stocks look good going into year end, and the stock market looks amazing. So I think we already have the answer to that broadening question. We already know that the market has broadened out and is not reliant. And just don't take my word for it. Looking at the 20 largest companies in the XLK, that's S&P 500 Tech, use that as your proxy for the AI trade, Judge. The median percentage of those 20 largest companies below their individual 52-week highs is negative 14%. So almost all of them are verging on a correction / bear market. NVIDIA's in a 15% drawdown from its high. Microsoft 13, Broadcom 18, Oracle, we know, much worse.
Amazon 12.
So
yeah,
I think we already have that answer.
Taken. Points well taken.
Well, here's the second point. I don't care which Kevin is the Fed chair. What I care is that earnings are going to be growing next year, in large part because of the benefits of AI, and also these corporations, mid-cap, large-cap, mega-cap, have just gotten really good at finding new ways to improve profitability, and we're going to see profit margins higher next year, according to Wall Street's expectations, from 13 and change percent up to like 15 and change percent. I think the use of AI is part of that story. But look, if we can do $315 in earnings per share next year, and we're at a 21 times multiple of that, I think there's still room for the market to have another good year next year. So what matters? Does the AI trade broaden out? Well, it already has. And will earnings deliver next year? Yeah, I think they will.
Is it that simple?
Well, I think it is, and I think you have to look at just today. Look at the 52-week high list in the S&P 500. I think there's nearly 30 of them. But it's Citi, it's Freeport-McMoran, it's C.H. Robinson, it's GM, it's Marriott. Yes, you have your Lam Research there. So it is about the broadening out, and I think that's the most important theme from an investment perspective that we carry into 2026, and the ability to kind of maintain that. As it relates to the Federal Reserve, look, I think it's built into the market already that you're going to maybe get one rate cut, maybe another rate cut thereafter. But I don't think the market's reliant in the second half of the year on further rate cuts. And in fact, if you're cutting rates in the second half of 2026, we have some sort of problem in the economy. So I think Josh is right to highlight the earnings growth, because we're coming off 4 consecutive quarters of double-digit earnings growth. And the expectation is that you're going to see that again as you move into 26. Now, is that expectation maybe a little bit too generous and a little bit too aggressive, potentially. But seeing strong earnings growth is going to lead you into the direction of saying, okay, I have a variety of different places that I can allocate capital, and that's a healthier environment than where we were just 9 months ago, where we're just thinking about 7 stocks in an AI halo.
The average strategist target for 2026 is about 11% upside from here. The average target is 76.29. The highest is 8,100 from Oppenheimer. You got an 8,000, and you got a lowest one of 7,100, which would be disappointing, obviously, if you're going to close the year at near 69 and you think you're only going to get 200 more S&P points in 2026. Liz, that would be a disappointment for many. What do you think of the range? What do you think of the top?
I think the range is average, right? The average annual return on the S&P is right around that range. So I think it's a safe range. And I think the reason we're seeing most of the targets in that range is because we've had over 80% returns over the last 3 years. So the chances, when you look over history, after 3 years of 80+% returns, the 1 year forward return is like 5%, right? So I think people are playing it safe by saying, the likelihood of us having another 15 to 25% year is really low. So we're going to just say average for next year, and it's going to come from different places. I think that's fair. I want to be a little bit more clear about the broadening out trade and what I think is really promising going into 2026. We're not broadening out into defensive areas. We're broadening out into very pro-cyclical areas. If you look just month to date, the performance and the leaders on the sector board, we've got financials, materials, industrials, right? This is all very pro-cyclical behavior, and the market is telling us that it's looking forward to 2026, and perhaps we even do better than we expect from a performance standpoint. I think the earnings growth right now is promising, and it's something to be optimistic about, but hitting that earnings target, I think, is going to be tough. So it's possible that earnings are a little overestimated and maybe returns are underestimated.
Hey, Weiss, we didn't even talk about, the headaches and the headwinds of tariff policy, right? Which, if you look at the market board like the S&P from year to date, which we have up there, you can see, obviously what happened when you had the so-called Liberation Day. So I wonder what happens to some of the tariff policy if it goes away even further into 2026, if that's when you get a upside surprise even to the more optimistic targets. If you get that headwind out of the way, because then we're not talking about, companies, they passed on this, they didn't pass on that. They ate this, they passed it to a supplier, their margins might do this or that. You eliminate a lot of questions around those issues.
And you also eliminate the question of what it's doing to inflation once you lap the Liberation Day.
Like the Supreme Court decision.
Well, that's because that's going to extend it then, if they have to pull them back, and who knows what happens there. But I think tariffs definitely become less of a problem going forward. I'm more optimistic on the market next year, and the reason is because it's typically rates that have played an outsized role in hitting markets because of an overheated economy, overheated inflation, and we've seen the market go through high interest rates and still move up. So I think that's going to support the market. So I'm positive on the market.
Does 8,100 sound realistic to you? I know you don't I know you don't like to you take shots at the targets, but it's not an exercise of target practice on doing that. But it's a sentiment idea that hey, if we can have a pretty darn good year next year, maybe we top 8,000. Maybe we can do that kind of number. That would be reflective of a pretty good environment for stocks.
Let me answer it this way. I think the direction's right. And to your point, I don't know if the target's right or not. And I am always bottoms up. So to me, it's what stocks can work. And I still like my positioning in the big cap tech stocks because of, again, the balance sheets, the growth, and I think you'll be out of that narrative of CapEx is too high, and I do believe you'll start seeing a return on it.
Well, look, like Wells Fargo today is standing by Oracle, for example, okay? Yeah. They have an overweight, they have 280. Yep. That's 45% upside. I find it hard to believe that if you can get 45% upside out of Oracle, that the AI trade's going to look bad and tech's not going to lead. Because if Oracle is going to do 45%, then you're like, okay, all of this data center build is real. Yep. All the debt worries are overestimated. and that this trend is durable for far longer than people, the bears on this topic, would like to believe.
Yeah, and there has been no really decline in data center builds. What we've heard, some delays are occasioned, and I know this factually because we're in that area, is you can't get the labor. Skilled labor is held very tight. You can't get the electricians, you can't get the plumbers, etc. So supplies are out there. So look, I still like it. Do I think that you'll get to a point where data centers can be overbuilt? For sure, but I don't think we're close to that at this point. As I look at how we're broadening the market out, I still like financials. I think this is 26 going to be a record year with a cooperative market and cooperative interest rates to get rid of all these companies that are on that private equity funds have been looking to exit. That, in fact, itself may be an issue for the market. Can it absorb all this capacity? So I like financials. I continue to look at Citi. I continue to look at Morgan Stanley.
5 weeks in a row for that space,
Yeah.
okay? Longest streak since September.
I will buy one of those too. I keep waiting for pullback, but I
One
just
of the
don't.
two of which? Citi and
or Morgan Stanley.
Morgan Stanley. Yeah, Citigroup. Just in the last month, Citi's up 19%. Morgan Stanley's up 13%.
Morgan Stanley's been the laggard year to date.
Yeah, Josh, how about you on that topic? I mean, like I said, you got the Oracle call. That to me says everything about if that works, then AI and NASDAQ tech's going to work. I mean, you're not going to have Oracle have some amazing year, and all of a sudden these other names are not going to work. Defense today of Microsoft outperformed 625 from Dan Ives. What do you think?
Yeah, look, I think the picture that I painted earlier in this A block about how some of the big AI names were in pretty substantial drawdowns from their highs, what I didn't get to is a lot of names that maybe we don't talk about as much, but certainly we talk about, look much better, and they are also part of that AI trade. Palantir is only 7% below 52-week highs. Who would have imagined that would have been the name that would have held up, given how it's obviously the most expensive? Cisco, 3% below 52-week highs. Micron is at highs.
Oh, I'm literally
IBM,
looking right at Micron. I'm glad you mentioned Micron. Staring right at it. It's up 223%. Year to date, it's less than 2% off of its 52-week high. Not talked a lot about until the last month.
Well, that's because it didn't really perform.
So these stocks are not acting
month.
like AI is unraveling. It's just people have gotten a little bit more sensitive on a stock-by-stock basis. And to me, when you hear people say, oh, it's a bubble, oh, is it really? Then why are half of the stocks involved down and the other half up? A bubble is indiscriminate buying regardless of price or even news. And we don't have that. We have Micron reacting really well to great news, and we have Oracle reacting really poorly to big concerns about the company's balance sheet. And then we have everything in between. And that's not a bubble. That's just a bull market.
Ed Yardeni says, expect the rotation into the S&P impressive 493 in 2026. Says the bull market's going to rotate away. That's because the Mag 7, he says, are facing more competition in the AI race from one another, as well as from other companies. The impressive 493 should benefit from that competition using new technology to boost their productivity and profit margins, Liz.
I agree. I mean, at the top of the show, that's what I said. That's sort of the broadening out depends on the idea that this will start to reach into other sectors of the economy, other sectors of the market, and that as competition heats up, it actually gets better for the other sectors that are going to use AI for productivity. It gets better for consumers that are going to use AI. The reality is we're still very early in this life cycle, and we have no idea how this is going to shape up for the next 5 to 10 years. I mean, the internet was sort of the same way. And the other thing about, if you're looking at what's happening in the economy and the Fed and all the transitions that are likely to happen in monetary policy in 2026, we've got, very simply put, a first half of the year that's characterized by stimulus and bond buying again. And then whenever this new chair gets into the seat, we've got a second half of the year that if it does reaccelerate, maybe they don't have to cut rates. Maybe they even start talking about pausing and having to hike at some point. Back in the 90s, that happened. They had to hike. They had to start hiking again because the economy heated up. The market did just fine. So all of this fear that everybody has about if we don't get the rate cuts we need, it's not going to work, I think is completely overblown.
I disagree with that. I disagree with Ed Yardeni's premise. I don't see competition heating up and that being the death knell for the performance. I actually see a market that's expanding at a pace that we've never seen with any other technology before, that's creating more opportunities for these companies. Now, aside from Meta and Google, Alphabet, competing for ad dollars, I think the ad markets continue to grow for them. I don't see the competition with
the
the product
dispersion
set.
among the group has already been taking place. He just suggests that it's going to continue to be that. If you look at the performance of the Mag 7,
yeah,
what was at one point all things looking kind of equal, not so much.
Well,
not so much.
And we've seen that periodically. I mean, at certain points, Microsoft's outperformed one, or all of them. I just don't think that that's the case. I think the stock market looks great for all of them, and the true economy market looks phenomenal for them. So I wouldn't make that determination.
I don't think the Oracle story is going away. That
Nope.
doesn't mean the stock can't rally in 2026. You're talking about, as it relates to Oracle, the need to continue to fund, whether it's for lease obligations or the spending, their free cash flow is going to go negative. That story is not going away in 2026. So you're going to have this environment, as I said, I used the word before, discerning, and I think that's the environment when you're looking at the Mag 7 names.
Well, what
and
about
the
what
AI
Yardeni
Halo
says?
names.
What about what
That's
Yardeni
already
says
happening,
about
though. The broadening out is underway. The question is it going to expand now into the energy sector? Is it going to go to some of the sectors that haven't performed this quarter? That's here. That's present.
Yeah, but maybe it can, like, for example, if you look at, since we were talking about financials, what about insurance? Roth Capital today says those are ready to break out, right? After they looked pretty good, they looked bad, and now they seem to be picking up again. You got a lot of exposure here.
Yeah, I do, and their assessment there is a little bit incorrect. Because what it is making a return. Remember, it was the insurance companies that led the financial sector in the early part of 24. And then as we moved into 25, they kind of lost their pricing power and underperformed the rest of the financial sector. They're coming back once again. Why? Because in most recent earnings, you're seeing that the pricing power came back once again. So I think it's a place that you could be in 26. They're reestablishing momentum. And I think the best thing that happened for these insurance companies is they worked off some of that overbought positioning and extreme bullish sentiment, because in the financial sector in early 24, they were really the story. You didn't have the money center banks, the regional banks participating at that point. Now you do. You have the dispersion in the financial sector.
Josh was talking about, you spotlighted regionals in terms of your best stocks column within the last week or so. Huntington Bank shares on the list.
Yeah.
Joe owns that. There seems to be, the regional bank ETF hit a 52-week high last week, so there seems to be momentum behind that.
Yeah, the consumer is okay, of course. Not every single consumer in the country, so nobody write an email. Generally speaking, the consumer is spending. Small and mid-sized businesses are navigating higher costs, and things are moving along. And we're maybe going to get a housing cycle. I can't say that definitively, but the 10-year cools off, and you get a little bit more relief in mortgages than we've already gotten. You're going to see an upcycle in housing, and so business lending, small business, mid-sized business. Housing and the consumer is what matters for these stocks, in addition to their net interest margin. And you've got this confluence of events where you're starting to get green shoots across a lot of those things. 17% of names in the KRE, Regional Banking Index ETF, are at 52-week highs today. That number averages over all months about 4%. So this is like a triple to quadruple better than normal situation for those names. And nobody owns them, like literally nobody.
Now, this is interesting. We'll take a quick break. And when we come back, we're going to tell you about one area of tech. January is the best month for it. We'll reveal it. We'll trade it. We do have ownership. We'll discuss next. Welcome back. BTIG's Jonathan Krinsky today says China tech is poised for a January rally. That January is the best month of the year for the CQQQs, averaging a 4.22% gain. Attractive entry point now for that trade. Weiss, you bought more BABA on Friday. So
I did.
Maybe that was good timing to do just that.
Yeah, and I didn't have that in mind when I did. What I had in mind was
presumably you didn't know that. As much as you know.
As much as I know
that.
No, I don't focus on minutia. I focus on what's important. Look, I think the stock is very inexpensive. They are the leader in cloud and will be and are in AI. So I think the same trends that we've seen with stocks in this market will continue in that market. Now the stock's almost doubled, over the last year, so it's not undiscovered. But I still think there's an appetite, including me, of skeptics to get involved in China trades.
He does mention Baba specifically in charts that, in his mind, look constructive, along with Baidu and Tencent and JOYY.
Yeah, I just think Baba is the horse in this race, and that you want to be involved with them.
You have a thought here?
I certainly do. China so far year to date has had a very strong return. If you look at the ETF, the MCHI, it is most recently that we've seen the pullback since October 1st. Why is that, Scott? I know you're a huge fan of the momentum factor.
I am.
If you look at when the momentum factor,
too.
When the momentum factor outperforms, okay, there's a strong correlation with other factors, equity styles, high beta names. And in fact, if you go back and study over the last 5 years, when momentum outperforms, China outperforms along with it. So ownership of a lot of the names we're talking about with China, the environment that they need is a strong momentum factor and a strong high beta factor for those names to work. Since October 1st, China's down 8%, momentum factor is down 1%. If you're telling me in January China's going to have outperformance, that means the momentum factor comes back once again.
Josh, you've been in this trade. I mean, Baba's getting a lift. What do you think about this Krinsky note? For something you've been in, I mean, you've done it through the K-Web in the past.
Yeah, on my radar. I haven't pulled the trigger yet. These stocks don't need me. They seem to be doing really well. But I do find it an interesting setup going into next year. I'm going to have to sharpen my pencil.
China was one of my contrarian calls in 2025. I've owned K-Web for a long time, actually added to K-Web on Friday. So I'm with Krinsky on this one.
All right.
I do think China has a good fighting chance. I mean, they're in this race, and they are fighting to win. I don't know that they will win the AI race, but they're in it. And I think that it's something to, certainly right now, a good opportunity to get in if you haven't been in it.
The good news is they don't have to win it, because it's a closed market. Baba just has to win it for themselves, and just have to see the expansion of the market, which we are seeing there, to have the same effect that we've seen here.
But it just feels like 2024 was like uninvestable, the idea on the desk.
Yep.
Right? 25, obviously, if you look at the gains, the CQs are up 31.5, K-Web up 19, but Baba's up 77% year to date. Baidu's 46. Other names are almost similar in terms of what the idea about this trade is. Now, who knows, with 26 can go back and be like, you know what, there's some regulatory thing that happened, now I don't trust it again, and then you see the volatility come back. But there seems to be enough optimism heading into the new year around these names, and then maybe the technicals are lining up with that too.
Yeah, in 24 it was India that you wanted to own over China.
I did.
And you did, and in 25 India has dramatically outperformed China. So look, I think
I owned India coming in.
That negative correlation is in place in 26. If it's going to be a strong year for China, then I don't think India performs well. And the alternative is, if China does struggle, I think you'd want to own India.
All right. Well, there's the Baba bounce, just about 1%. We'll watch that.
This is a company going through a turnaround. Reported earnings last week. The earnings were good, and they got a bunch of price target bumps from Wall Street. And you can see that the stock had been rallying going into those numbers, so nobody was shocked. But next year will be a better year on revenue, on pricing power, on margins, on earnings per share than this year was. And I think 300 to 315, give me like a little bit, give me like a 5-year chart. What you can see is that this has been an area of resistance that is now being challenged again. I don't believe in triple tops. So you see late 2020 into 21, 300 was resistance, rejected. Then again, it happened in 2024. Here we are going into 2026, third time's a charm. I think the stock will break out because it's not just technicals. It's a fundamental turnaround here. And I still believe that there's opportunity. I would anticipate the breakout, and I would start getting long right now.
Okay, let's see what we think on the desk. What do you think?
I like it. I think there's a global logistics story that really is very quietly underneath the market in a very strong bull market. We have ownership of Expeditors International. That gets you 70% revenue exposure outside of the U.S. I like the names that Josh is mentioning here, FedEx and the rails. I think you could even turn to a name like Prologis, ticker symbol PLD. That's giving you the participation in what is right now a bull market for global logistics.
All right.
And I think
you like the exchanges in general. Why hasn't this one worked relative to some of the others? Why hasn't CBOE?
CBOE.
Yeah.
CBOE,
Yeah.
I think since earnings, maybe positioning was a little bit full, maybe it was sentiment. I don't think you could identify one specific reason why, in fact, the stock has been experiencing the relative underperformance. There has been very strong enthusiasm around the usage of options in the capital markets. I think that led to a lot of people owning CBOE. And I think CBOE is going to be fine in 26. I think from where it is right here, I'll look back, I'll say it was a poor sale, but it's really understanding what I use as an indicator, and I don't like relative underperformance versus an industry or a sector.
Well, you might say this is a good sale because, Morgan Stanley has reiterated they're underweight on CBOE. Josh, they reiterate they're overweight on NASDAQ. They take the target to 111. CME Group reiterated overweight. The target goes to 320. Schwab, they put in that group, reiterated overweight, and the target to 148.
Yeah, it's a strange grouping. Schwab doesn't really belong with the other three. The other three are exchanges, and directionally, not as important what happens with, for example, rates or stocks. I mean, obviously, in an upward direction is more helpful for certain types of business, like NASDAQ, but volatility is better for, CBOE. So, the driver is just increased activity, I guess would be the point. Whereas Schwab, a lot of the money being made there is coming from sweeps on cash balances, et cetera. So maybe the rates picture is more important for them. But I still think they do well with a rising tide, asset management businesses, et cetera. I like Schwab. I really like NASDAQ. I think it's just a crown jewel amongst this group. They're benefiting from IPOs. They're benefiting from more data, listing activity, trading, just so many different ways to win.
Okay.
Gas is up around $5. I already own EQT. That has been a strong winning position for me. I added Apache as natural gas approached $5, believing natural gas was going to break out above $5. It absolutely has not done that.
How long have you owned it?
Back over.
Well,
Apache's a couple of weeks at most. It's a terrible trade. Down maybe 8% on the trade.
Oh, you are?
Yeah. Got right out of it.
Okay.
Moved to the sidelines, natural gas right back below $4.
Okay. Because I have it up 3% in a month, 4.5 in 3 months. So really, you're talking about a very small period of time that just didn't work.
I probably bought the high of the entire move. I know that
natural roll, right?
Don't you want to buy high and sell higher?
And sell higher,
you do,
right?
Yeah.
Sometimes that doesn't work out.
Himself in his book.
Yeah, and sometimes that absolutely doesn't work out.
He talks his own book.
Yeah.
Natural gas was $5 a time. I'll tell you a trade that is working that I bought at the high.
Okay.
GLD. Bought that 1 month ago, up about 10% on GLD, and I think that continues to move higher because gold's going higher.
You still optimistic about that for 26?
I am. I'm optimistic about gold. I'm optimistic about silver. I like that Liz is nodding that she agrees with me. Yeah, I am.
I agree with you on gold. I agree with you on gold.
On gold?
I was optimistic about gold in 25, still optimistic in 26. Silver is a speculative commodity more than gold is. I think there's more of a floor on the gold demand. I don't think that you see as much of a possibility of a drawdown, but silver's up a little high for me, a little fast.
Okay.
So there.
A little high beta, silver.
All right.
Yeah.
We'll do finals next. 3 o'clock Eastern closing bell. Tom Lee will be with us. Jeff DeGraff, Richard Fisher, Stephanie Link, Malcolm Etheridge, Chris Harvey. We'll kick around the key questions facing you in the new year and this market. Josh Brown, your final trade is what?
Toast, snapping a declining 50-day moving average headed higher.
All right. Why is your toast? What do you got?
In a similar move.
Keep it up, your toast.
Uber. I think Uber, it's bouncing today. I think it'll continue to bounce for a little bit.
Okay. It's a nice looking bounce. Liz?
Materials expected to be the second best sector in earnings in 26. Cyclical bounce, hopefully incoming.
Joe T.
No better reflection of the broadening out trade than the XBI and the performance it has had over the last 3 months.
Well, you said that was your favorite trade in the market right now.
It's been the best trade for me so far personally in 2025.
Okay.
And there's very limited time left in the year. So I think it continues to move higher above 125. I think this is talking 145, 150 at some point in early 26.
All right, speaking of limited time, we're out, which leads us to our talk of the tape. What 2026 will hold for your money? Let's ask our panel. Everyone here at Post 9 today. Fundstrat's Tom Lee, iTower's Stephanie Link, and CIBC Capital Markets' Chris Harvey. Tom and Steph, both CNBC contributors. One and all, it's good to have you right in front of us on the desk today. All right, Tom. So, 2023, we turned in 24%. 2024, we turned in 23%. Pretty good this year, too, 17%. Next year, we fill in the blank with what sounds reasonable to you.
I think it's still possible to have a double-digit year. There have been 12 times in the last 100 years where markets posted 3 years of 20% gains. This year hasn't finished yet. Globally, half of the time, markets do even better in the following year. So I think next year is a year where the debate's going to be, is the bull cycle over or is it going to extend? I think it's going to create quite a lot of volatility in the first half, but I think GDP growth stronger. We have a dovish Fed. Valuations are reasonable, so I think we end up exiting very strong.
Why a lot of volatility in the first half then?
Part of it is the Trump tariffs could get overturned. There is a possibility of an extended government shutdown. The nomination and then confirmation of a new Fed chair is going to take 3 months. That could be very controversial. I think all of that happens in the first half of next year.
How's that sound to you, Steph?
I think that sounds really great. The economy is on solid footing. We've been talking about that all year long. Last week, we got some really encouraging data with regards to weekly jobless claims. Inflation came in a little bit better. We've talked about the H8 Federal Reserve loan growth, lending. That's actually at a 9-week high, all-time high for loan growth. That's very bullish for activity overall. The industrial metals are at all-time highs. And you have global central bankers, including the Fed, getting more and more closer to the neutral rate. That's a good thing. And Fed cuts take a while. There's a lag impact, and I think that's going to bode well for next year. And then you have the one big, beautiful bill. $150 to $175 billion going into the consumer's hands, going into corporate America, so CapEx continues. You add it all up, and I think you have double-digit earnings growth. There are some numbers out there that are a little high, like 16, 17% in earnings growth. I'm not there, but I do think you're going to see low teens.
Mr. Harvey.
I think high single digits is reasonable.
Single.
I can't get to 10%, 12%, 15 just yet. Right. One of the things that Tom said, I agree with wholeheartedly. The first half, you're going to see a lot more volatility than you have seen in a while. I think people are sleeping on the macro risks, be it USMCA, be it the transition with the Fed. If you listen to Powell, now he wasn't cocky about this. He was very humble. But basically what he said is, I'll see you at the book signing. We have growth higher, we have inflation lower, we're back to neutral. We don't need to do anything from here. And 6 months, if you don't cut rates for another 6 months, that's an eternity in the financial markets. And then the last thing is, I think corporations are going to, after a good year this year, they're going to manage down expectations. As you manage down expectations, that puts a little volatility into the marketplace. And lastly, risk is priced very, very expensively, either in the equity markets or the credit markets. It doesn't take much to upset the apple cart.
You want to respond to that? Because it seems like, if not a step-by-step counter in some respects to your view, it certainly is enough of one. I mean, there's going to be more volatility. We're underestimating, maybe too complacent about macro risks that are out there, among other things. What do you say?
I mean, I feel good about the macro environment, all the things I just said. And I think it is a consumer that has been resilient. We've been talking about the consumer forever, how they have hung in there. Yes, it's the high end, not the low end. That tends to be the case on a regular basis, unfortunately. I don't think the AI infrastructure CapEx cycle is going to change in 2026, and that's fueling about 3/4 of the GDP growth. And I do think that we always have a wall of worry. And I've said it, you've heard me say it, Scott, I worry when I don't worry, because that means that we're complacent. I think there's a lot that people have on their minds. I think we're going to be able to get through it, because fundamentals at the end of the day, they run the show. And if you do have an economy that grows 2.5%, 3%, we're growing north of that now, But if you have an economy that's growing 2.5%, 3%, typically that's been a 10% earnings growth. And I think we're going to be a little bit more. And you have lower interest rates. By the way, you have lower gasoline prices. You have lower egg prices.
But address the valuation issue that stocks are. You want to go there?
Well, it's all about earnings, though. It's if I think if earnings are growing in double digits, then I do think the valuations are very attractive, especially in other sectors beyond tech.
Yeah, and we have to keep in mind the equal weight S&P 500 PE is 17 times. It's lower than it was 5 years ago. So the market actually has derated in the last 5 years because of these black swans of the shutdown, inflation surge, fastest Fed hikes in history, et cetera. So actually the equal weighted market is cheaper. I don't think risk is actually that expensive.
Listen, so let's turn it to small caps for a second, just talk about risk. There's two indices for small caps, Russell 2000, S&P 600. Both small cap, they should perform pretty much in line with each other. Russell 2000 is outperforming by 8% this year. Russell 2000 outperforming by 8% because S&P 600 is a high quality index. The things that don't earn money, the things that have excessive beta, all really driving that marketplace. So I see, if you look at IG credit spreads, less than 80 basis points. If you don't know that market, that is tight, right? If you look at the S&P high beta index, it's up 35%, 34, 35%, double of what the S&P is. I see a lot of froth, right? There's a price for risk. It's here. I think the price for risk is down here.
Interesting. I mean, it is one of the key questions, no doubt, is whether the broadening story that we've been talking about has legs. And what do you need to reach some of the loftiest targets from strategists that are out there? I mean, the top one's 8,100. Dom Chu joins us now. I mean, it's a nice range, Dom.
It's a big
81's the top, as you show right there.
Yeah, that's right. 81's the top. That's John Stoltzfus over at Oppenheimer right now. So that implies a pretty decent sized gain. And the lowest is still bullish, only about maybe 4 or 5% higher than current levels right now. But that's Savita Subramanian over at Bank of America. So 7,100 is the low end of the 15 strategists that we've surveyed here at CNBC. 8,100 is the high end. The middle, 7,629, actually implies upside of just about 10% or so from the current levels that we're at right now. So generally speaking, we could get to, if we get to the average target price, a double-digit gain for the S&P 500 by the end of next year. As for whether or not we can see the contributors for that move higher, yes, it's always been about Mag 7, but these days we're seeing a little bit more relative strength in other parts of the market that imply maybe a broadening out trade. Check out the small cap ETF, which is already up 21% on a year-to-date basis. The mid caps are up about 11.5%. Underperforming, though, the S&P 500 at 15. So the small caps getting some legs and some steam that could bode well for the broadening out trade. As for the sectors that could be interesting here as well, check some of these out. Because over the last 3 months, it has been healthcare, financials, and industrials that have been among the star performers on a 3-month basis. So do they carry some relative strength or momentum over the last 3 months into the early part of 2026? That's going to be key as well. As for some of the individual industries that are leading the way higher, speaking of the broadening out trade, the XME is the Spider Metals and Mining ETF. That's already up about 89% so far just this year. The ITA is Aerospace and Defense, which is 51% higher. And the NASDAQ Biotech ETF has been a standout, up 30% so far. So as we talk about the broadening out trade, some of the best performing industries and ETFs out there that track them are not tech or comm services related. There are other parts of the market, so that's going to be a real key for that trade in 2026, Scott. And by the way, for more on that story, just head over to cnbc.com/pro. Subscribers get all the context and detail around those big calls out there. I'll send things back over to you, Scott.
Yeah, that was great stuff, Dom. I appreciate you for that. That's Dominic Chu. So you've already had a good amount of broadening. The idea that the market hasn't been broad is a fallacy, really.
I mean, yes and no, because when you look at 3-year stacked, it's still Mag 7. And so I think it makes sense to not just look at 2025 by itself, but how have stocks done since the end of 2022. To me, there's a lot of room for cyclicals to really outperform, including financials, because the ISM's been below 50 now for almost 3 years. That hopefully turns up above 50 next year, and we get a pretty, I think what I consider a cyclical broadening of the market.
To outperform tech?
Yes, and Steph and I were talking about this, that I think tech earnings visibility is still good, but the multiple expansion story doesn't have as much upside as industrials or financials or energy or even basic materials.
It's funny because you just bought more Meta.
I did.
Like this morning or yesterday,
I did,
right?
this morning, yeah. I still like it very much. It's still down 6% from its highs. I still think that they win from AI and what it's going to mean for their ad business and for their messaging business and customer apps business. The metaverse cost cuts are $5 billion in savings annualized. Gives them $2 a share, again, annualized in earnings. I think this company can actually deliver $36 to $38 a share by 2027. That puts this thing at 18 times earnings, and it's growing earnings at 20% and revenues at 26%. All that being said, so it's a big position, top 5. All that being said, I am underweight other MAGs. I really only own Amazon, very small Microsoft, but I do think that financials are going to be the sector leader next year because we're not pricing in on a valuation point of view. We are not pricing in all the deregulation that is going to come and the excess capital that is going to be returned to shareholders and, by the way, lead to loan growth, which is why I look at the H8 data. It's really important to see what banks are doing. If the banks are lending, that's going to help the entire economy as a whole us grow. And these stocks are not expensive. Capital One is at a 12 times multiple. You know, even Morgan Stanley, expensive, right? 17 times. Bank of America, 1.4 times book. I think that there's a lot of runway left to the financials, and that's the sector that I've been overweight for a long time, and I continue to be.
You agree with that?
We like parts of the financial. We really liked the financials about a year and a half ago. Now we're just being a little bit more selective. I agree with some of the broker-dealers, some of the credit card companies, relatively cheap. I think there's some upside.
But not the big banks?
The big banks are fine. I just don't think they're an overweight at this point in time. Right? They performed exceptionally well. Actually, JP Morgan's outperformed a big section of tech over the last 3 and 5 years. So it's performed, right?
But why wouldn't you be overweight that group? I mean, if you think that earnings are going to stay strong, the economy is going to be good, you're going to get more deals, you're going to get more IPOs, all of that, deregulation and everything. That feels reasonable to expect all of that.
It's reasonable. I think a lot of it's in the price. I think they need to either pull back or consolidate. And if they do either one of those, we'll take a look at them. But I agree with Stephanie. The deregulation story has more to play. But in the banks, I just don't think it's the right time to do it. They perform so well. Valuation is fine. The underlying fundamentals is fine. But there's nothing undiscovered there where we're saying, got to own the banks.
Well, we haven't had a net interest income cycle in about 10 years. And the steep yield curve will be very beneficial for that.
Yeah, but I thought you talked about yields coming down.
We're seeing a steepening in the yield curve.
I know we are now. But I mean,
that's very positive.
Well, because the front end of the curve's coming down because on expectations of rate cuts.
That's okay. I mean, rates are coming down on the short end. Probably 10 years kind of sits here. Maybe it goes down a little bit. But I still think you're going to see a steepening yield curve. And that will help a big part of the bank's earnings, which is almost 50 to 60% in some big banks' cases. That's their revenue generation. So I think earnings estimates are going much higher, and that's why I want to be overweight.
All right. Well, yeah, you got some.
I was just saying, just to add to Stephanie's point, I think tech-forward banks that are using AI also are big margin stories because employee compensation is their biggest expense. I think banks are going to look more like tech stocks in the future, where they use AI to reduce employee dependency and earn the same money and their multiples go up.
All right, well, speaking of AI, one of the critical questions is, can we get past all the bubble banter talk? Well, bubble banter, really. Kind of redundant if you say banter talk. Deirdre Bosa joins us now with that critical question because we're obsessed with it now. I wonder what early 26 is going to bring.
We're probably going to be obsessed with it for some time, right, Scott? I mean, the AI trade, for now at least, in the last few days, back on its feet, but none of the big questions actually went anywhere. This data from SimilarWeb, it gets at one of the most important questions in the whole trade, OpenAI versus the Google AI universe, not just on models, but across the stack and what each one represents. Now, from January to November of this year, OpenAI gave up a little bit of market share. Google, though, grew its market share from about 6% to 15%. This suggests that Google has the momentum and is finally converting distribution into real gains. Now, it's also quietly challenging NVIDIA on the hardware side with its custom AI chips known as TPUs, and that could impact the entire cost structure, what we know of it today in the AI trade. Now, going into next year, there will continue to be questions around whether OpenAI can meet its own ambitions and obligations while competing with an incumbent, Google, that controls the entire pipeline. Something else I want to mention, Scott, there's this really interesting debate going on at the very highest levels of AI right now. It's playing out on X between DeepMind's Demis Hassabis at Google and Yann LeCun, who just left Meta. These are two of the most prestigious people in AI. Hassabis is arguing that today's scaled models, they're already on a credible path to general AI, while LeCun is saying the current approach is a dead end without a new architecture. So if Hassabis is right, scale, chips, infrastructure, those things keep winning. But if LeCun is right, a lot of today's CapEx is going to look premature, and the payoff gets pushed out. And that is really the central question on the bubble, right? Can we justify all of this spending?
Yeah. And maybe we don't know the answer for a while. Dee, thank you. Georgia Bosa, Chris, you say that the tech bubble does not pass our litmus test.
Yeah. So again, it gets back to something like JP Morgan banks, which is outperforming. Go back to late 90s, and the banks really underperformed. Here, the banks are actually leading the way. Multiples that we're seeing, still not excessively high. You go back to late 90s, whether it's Oracle or Cisco, you're not seeing it. More importantly, let's go to, can you fund these risky endeavors? If you go to the credit markets, anything not named Oracle, you can go out and you can still fund. And so this market is still rather healthy. Valuations are not high enough at this level. We don't see the frothiness that we saw back then. And the commercial aspect is so much better now than it was in the late 90s.
So you think the Oracle situation or issue or whatever is idiosyncratic to itself?
That's what the market's telling you. The market's telling you that Oracle is very idiosyncratic. If you look at the credit spreads, if they came to the market, you'd be questioning how much can you bring to the market, at what spreads. If anything else, any of the other hyperscalers came to the market would probably not really think about it and digest more or less anything that they brought to the market.
You think we continue to have dispersion among these stocks? Yes, Alphabet is up 63% year to date. NVIDIA is up 37%. Microsoft is an underperformer slightly to the market, as is Meta, as is Apple, as is Amazon. Does this continue?
Scott, I'm going to say something that's not very popular, but I still think they trade as a basket because they do all have linkages to the same theme, but at different points of time, some will lead versus the others. And so I have clients that do mean reversion among the Mag 7, but I think that they're largely one complex.
Okay.
I hope we get mean reversion in the names that I own, because Meta obviously has a ways to go, but Amazon does too. Out of all the Mag 7s, that one to me has been the most surprising, that it just can't get out of its own way.
You agree with what he said, though, that you're going to get back to trading like a group? Because the stocks would suggest otherwise.
Yeah. No, I actually think that at any given point, you have a couple of leaders and a couple of laggards. And I think I'm betting on that the fundamentals are strong enough in the laggards that they will mean revert next year. That doesn't mean that Alphabet is going to fall 50%, but maybe it just trails for a little. Maybe it takes a pause. Same thing with Broadcom. As you know, I've said that before, that maybe it just takes a pause because it has crushed NVIDIA over the last year. And that's okay, but the fundamentals are still very, very strong, sound. Estimates are going higher. And when estimates go higher, no matter if these stocks take a pause, eventually the stock prices catch up with the earnings revisions.
Last point to you. How will these trade?
We like the software space. We think it's more selective. It's not over. And we think the best risk reward is in the software space.
All right, guys. Good holidays to everybody. Look forward to many conversations in the new year. Thanks for being here.
Thanks, Scott.
Let's send it to Steve Kovac now for a look at the biggest names moving into the close. Hi, Steve.
Hey there, Scott. Yeah, shares of Tesla, they're gaining almost 2% after the Delaware Supreme Court ruled on Friday that Elon Musk's pay package must be restored. Also this weekend, Musk said those robo-taxis were unaffected by the power outage that disrupted Waymo operations in San Francisco. Meantime, Dominion Energy shares sinking over 3% after the Trump administration paused the leases of 5 East Coast wind projects, including Dominion's coastal Virginia offshore wind project. Interior Secretary Doug Burgum said the move was due to needing some time to assess possible national security risks. And shares of Paramount Skydance up about 3% after the company said it guaranteed Larry Ellison would pay back an amended offer for Warner Brothers Discovery, sending those shares also up 3%. WBD has already accepted an offer from Netflix, and P-Sky notably did not increase its bid as part of this latest development. We see Netflix shares, they're down about 1%, Scott.
All right, Steve. Thank you, Steve Kovac.
Hello, everybody. Welcome to Blue Cloud Trading. I'm George. It is Tuesday, December 23rd. We just saw some clips from the halftime report and closing bell yesterday. We saw Tom Lee, Josh Brown sharing some stock picks and some of the other guests as well. And what I'm going to do in this video, in this video segment, we're going to go over the index ETFs, like the SPY, the S&P 500, the Qs, the Dow. And are you ready? About 30, in fact, exactly 30 stocks and mixture of stocks and ETFs in here. What I've done is I've analyzed these from a technical perspective to see these were all discussed on the shows. Okay, so we're going to look at these and see if they make sense from a technical perspective, and I'll explain how I come to that conclusion. We're going to look at some of the Mag 7s, not all of them. Okay. And we're going to look at one of our members' requests. Just a quick reminder, the stocks that I cover on the members and the members only video each weekend, those specific stocks I only cover on the in those videos. I don't cover those during the week. So there may be some stocks that were discussed on the show that are maybe in the portfolio, and those will be talked about this weekend. Anyway, let's get into this, and let's quickly review how the markets are doing right now as we speak, because it's currently the market is still in session right now. It's 12:35 p.m. Hold on, no, 12:40 p.m. There's the actual time right there. That's Eastern time. Okay, I'm five hours ahead actually in Tenerife. Okay, Tenerife Island in the Canaries in Spain. So most of my day is already gone, but as you can see, the Dow up 0.20%, NASDAQ up 0.37%, S&P 500 up 0.31 today, and the Russell 2000 is actually down 0.40. So let's look also at the heat map, and that's going to give us some introspective on the actual individual stocks. And you'll notice that NVIDIA up 2.26, Broadcom up 1.9, Amazon is up 1.25 right now, Google is up 1.29%. Some stocks like Oracle, Palantir are down there. Berkshire's down 0.16. The healthcare like Eli Lilly and Johnson & Johnson are down slightly. But the utility stocks did well. Some of the energy stocks like Exxon, CVX, they're doing pretty good. JP Morgan's up 1.03. The consumer defensives are a little bit mixed. And so, yeah, that's what we've got going. Let's take a look at the groups as well real quick before we can go back to the actual individual stocks that I'm going to analyze. So if you look here, you'll see that today communication services and utilities and energy are up, and technology, and real estate and consumer defensives are at the bottom there. And this is the 1 week performance with basic materials at the top, consumer defensives at the bottom for the week. We are getting close to the end of the month, and basic materials has been the leader this month, up 13.15%. Followed by financials, consumer cyclical, industrials, and then technology only up 4.93% for the month. Utilities down 2.08%. Real estate and energy also down. These are the three sectors that did not perform that well this month. Maybe there'll be a turnaround story this next month, January. All right. This is my channel, by the way, Blue Cloud Trading. If you're coming to this channel for the first time and you want to support me, hit that subscribe button and notification bell. It's free to do this. If you want to get access to the member-only videos that I do each weekend, I go over my entire portfolio. It's usually about an hour-long video. You can see this one was an hour and 18 minutes, which I basically published on December 19th. And I also share 25, on average, new stock ideas as well. I also explain why I'm entering, why I'm closing out of positions throughout the week. And then you can also, once you become a member, you'll also be able to access the older videos as well, so you can see how I've performed over time. And then basically you want to click that join button right there. These prices here, if you want to lock these prices in for 2025, now is the time to do it before the new year. The prices will be going up, and so now is the time to do it. You will be locked into those prices. If you cancel your membership sometime in 2026, then you'll have to renew at a higher price. So just consider that. Either become a Blue Cloud supporter, a Blue Cloud trader. Now, under this level, this is when you'll get access to those exclusive member-only videos. And under Blue Cloud Legend, You will get access to the videos. You'll get access to some day trading videos that I've got recorded, as well as daily trade updates, which I post. Okay, I'll show you. Once you become a member, there'll be a new tab that pops up, and it will look like this. It will say membership. You click there, and you'll see my posts each day, where I give more stock ideas as well as the actual trades that I've placed that day. And that's usually before the close of the day. All right. Okay, so let's get into it. We've got a whole bunch of things to talk about here. So, like S&P 500 today is doing pretty well. It's up 0.32%. Now, if you notice that it has a little blue flag here next to the ticker symbol, that means that these two symbols here are the strongest today, the S&P 500 and the Qs. They're passing multiple tests on both the weekly chart and the daily chart from a technical perspective using this indicator, Japanese indicator called Ichimoku. Google that one. It's a really great indicator that will help, basically identify the strength of the trend. How is it doing? Briefly, I'll just give you guys a quick little overview of how it works. And let me get rid of all these lines just for a moment. Here's the S&P 500, for example, and we're looking at a weekly chart. And we've got price, basically, these Japanese candlesticks. Okay, there's price, 687.08. As you can see, the price is changing because we're midday right now. We want that price to be above the green line, which is the 9 period. It's the midpoint of the last 9 periods, plotted right there. We want price to be above the Kijinsen, or 26 period. So this one's called Tengen-sen. This one's called Kijinsen. And that's the midpoint of the last 26 periods for the red line. It's plotted right under the candle. Then you've got this white line, the lagging line called Chiku span. The Chiku span is actually the current price projected 26 periods into the past. And what you want to do is, check to see where is that white line in relation to the candle 26 periods ago, which is that candle right there. Okay. If that white line is above it, it's very bullish. If it's under, it's a bearish scenario. You can see what happened there. And then finally, there's the Ichimoku cloud itself, and that's basically plotted by taking the midpoint of the Tengen-sen and the Kijinsen, these two moving averages, the absolute middle, projecting that 26 periods into the future. That's where you'll always find the Senku span A, that light-colored blue line. Okay, and then you've got the Senku span B, the purple line, the other part of the cloud, that is derived by taking the midpoint of the last 52 periods and then projecting that into the future. So we've got some information here about the future, the past, and where we currently are, the present, the past, and the future. It's a very unique indicator that was developed in the late 1930s, and then it became published in the late 1960s, and it's been very popular, very used a lot by financial institutions, okay? So including the technical head of technical strategy or technical analysis there at Fundstrat, Tom Lee's group. Anyway, yeah, I've been using this for years, and I really have found it to be very useful because it can quickly tell me whether or not I should even be, analyzing a specific stock or not. So I'm looking for price, like I said, to be above all the moving averages, that Chiku span above price, and we've got that on the weekly chart. Do we have it on the daily? Yes, we do. Okay. So when you got both of those time frames giving us confirmation, that's when I give the ETF a blue flag. All right. And right now, if we throw on some more technicals, these resistance levels like the 689.91, it's based on this candle right here, the high of that candle, which was back on October 29th. So we came close to it right here, as you can see, back on December 11th, and we pulled back. We have not broken through it yet. That's what's necessary for this, this trend here to continue, essentially, because if it does start to pull back, that could be very negative for the SPY. The QQQ ETF also gets a blue flag. I've already reviewed all these ETFs. You've got here on the weekly chart, it's above Tengen-sen, Kijinsen, and same thing here on the daily. Now, the cloud itself is it's like right about to merge, as you can see there, and it could turn negative. We'll see if that happens. One thing I don't like about the QQQ ETF right now is if you look closely, you'll notice that we've got a lower high here from the prior one. So if you were to draw a trend line, you can see that right there. And I feel like we need to break that line. We need to break this 637.01, this prior high, to see, so that we get more confirmation about this, the continuation of the trend itself. All right, let's look at DIA ETF, which does not get the blue flag. And the reason it doesn't, I'll show you why. It's missing one of the elements. On the daily chart, right now, let's see, 484.39. So as you can see, or 484.38, that little box that popped up, it's currently under the green line, but it's about to break above. So at the time that I reviewed it, which is about 15, 20 minutes ago, it was basically under, and it still is. So it looks like it wants to break through. So we'll see if that can happen. Of course, on the weekly chart, everything looks pretty bullish still. Very strong trend here for the Dow. Russell 2000 is currently down 0.52% today. Here it is in the weekly chart. Very strong trend overall, but it's kind of stalling at this 252.77 level. So IWM is the ticker symbol for the ETF if you wanted to have a position in the Russell. And here's the daily chart. You can see it's currently under the Tenkan-sen, the 9 period there. So that's not a bullish time to be adding a new position, basically. All right, so I wouldn't jump in quite yet. The VIX is dropping. Now this is the one thing that you do want to see dropping. This ETF here, the VIX-X Market Volatility Index. It represents fear in the markets, and if that's dropping, the market's usually doing pretty well overall, and that is doing good. It's at a level of 13.85, which is a safe zone. I like that. And then we've got FEZ, the Euro Stoxx 50. Now let's see, on Friday last week, it was above the Tenkan-sen, but you can see here on Monday, it gapped down under the 9 period, and it's staying under it still, even though it's up 0.06%. So it's just taking a breather, and I would not be jumping in quite yet into the FEZ. All right, hold off on that one. All right, let's go into the rest of these now. I've done the same type of analysis, looking at both the weekly and the daily on all of these 30 items that were talked about on the CNBC shows that we just watched. And the ones, as you can see here at the top with the blue flag, are the ones that look strong. The ones on the bottom, not so much. Okay, so as I was looking through these, I realized that I had accidentally added Citigroup in there. So I will be covering that one over the weekend. So there's really 29 stocks that we're going to look at. So let's start off with FedEx. FDX is the ticker symbol, and it has a blue flag. And here it is on the daily chart. Very strong uptrend, very clear. Ichimoku stands for at a glance. At a glance, we can see very clearly that price is, in fact, above the moving averages. It's above the cloud. Everything looks great. I like that one. And it looks good on the weekly chart, too. I've already reviewed these. GLD. Let's look at gold. Also fantastic, right? In fact, let's take a look at this prior high. It broke through that. You can see the high there of 403.30. Let me go ahead and type that in there. I want to make sure we get the exact high level. It was broken yesterday on Monday, December 22nd. It gapped above it. Notice how, and this is an interesting thing that can sometimes happen, price can get stalled at a level of resistance, and then it just takes one candle, one day for the price to break. And when it does break, many times it will just gap right above that level of resistance. That's what happened. I'm expecting this to continue to the upside now. I like GLD, okay? General Motors, looking great, okay? Great chart. Nothing negative about gold General Motors, as you can see here. HBAN, which is Huntington Bank Shares. HBAN is the ticker symbol. That one's also looking pretty good. It is down 0.56% today, but it's holding up quite well above the Tenkan-sen right there. It's creating a little bit of a cup right there. Maybe if it breaks above, let's see, let me just go ahead and draw this level here. Expect it to basically continue to the upside. Where will it find resistance? Probably around the 1844 level, which is a weekly. Let's take a look at that weekly level. It's based on that little candle right there, that tiny candle. So that shooting star from November 29th, 2024, that's what it needs to break in order for us to really take notice and recognize that it's got more potential to the upside. KIE. Looking pretty good. This is the S&P Spider, S&P Insurance ETF. Now this one too also has some resistance. I'm going to throw that resistance level right there. You can see the high of 62.47. That's what I'd be looking for. That's the all-time highs, and that's what you want to look for when considering adding a position. Because here's the deal: we are super close to it. We're only about 2.5% away from that level. If we break above that, okay, there's going to be more interest in this ETF, and then you'll notice more volume coming in. And so I personally love when price is consolidating for that long of a period, because when we do finally get a breakout, people get more excited about the concept because they know there's going to be more move to the upside at that point. Micron Technology also looking great. Here's the weekly chart and here's the daily. Okay. So you can see that too just recently broke through this prior level. Throw that up there. Actually, this is probably the most recent high is this candle right here, 264.75. Let's go ahead and put that in there. Now that's a level of support now. So once the price breaks through, like it did on that specific candle on high volume, okay. And by the way, we also got confirmation on with a directional movement index right here, because the green line was above the red line. The positive DI9 was above the negative DI9. I've got it at a setting a little faster than the typical setting. And then the ADX9 is also moving up. That means the momentum is increasing to the upside. So I like Micron. And by the way, like I said before, if it has a blue flag, if I switch it over to a weekly, it's going to confirm that yes, this looks good on both time frames, right? We've got a future bullish cloud, prices above the moving averages, everything looks great. Why is it important to have both time frames confirming and not just one? Think about it like this: the weekly chart, it takes a while to for this, of course, to each one of these candles represents a whole week, right? We want to be on the right side of the long-term chart. We don't want to be under the cloud on the weekly and then breaking above on the daily chart. There's a higher likelihood that it's going to fall apart, the trend. But when you've got confluence, when you've got both time frames confirming, okay, then you've got something, basically. So that's the way I look at it. And you'll have a higher success ratio with your trades, basically. NDAQ, okay, on the weekly chart looks pretty good. Did it break through this level here? Let's find out. Yeah, it did. So the high there was 97.63 and 97.46. So yeah, it's at 97.90. This is a great situation right here on the weekly. If it can, now here's the other thing that I should mention. If it closes above that level by the end of the week, it needs to close above that level for the weekly candle to form above there to confirm it. All right, because it could certainly pull back still on the weekly chart. On the daily chart, we're currently above it. You can see that little tiny candle that's forming above there. So we'll be watching. NDAQ is one to watch. PLTR, Palantir. Let's look at this one. On the daily chart, looks pretty good. I like it. And like I said, the weekly is going to look great too. It is down 0.29%. Let's see. SCHW, Charles Schwab Corporation, is another stock they talked about. That one broke above that high right there from July 29th, 2025. And now Charles Schwab is hitting all-time highs. It's in a good spot, even though it was down 0.43%. So just a 1 day's performance is not going to give you an indicator of the total strength of the stock or ETF. Here's a weekly chart that's going to show you the same thing I just mentioned. You can see that price was dropping here, right? It broke above that trend line right there and closed above it with this candle, and then it's now continuing, and now it's breaking through that 99.59. So that's what you want to look for. ADX is moving up. The directional movement index looks very bullish here. Silver, SLV. Look at silver on the weekly chart. I mean, it's going hyperbolic. I mean, every week it's just gapping up. On the daily chart, very strong chart. So I like silver, obviously, SLV. And by the way, in the weekend videos, I go into a more in-depth analysis of all the sectors. And then I also break down the strongest industries within each sector. That's important, okay? And then break down further into the strongest stocks within each very strong industry. And those are typically the stocks that I'm, sharing in that video with the members. And so, get an upper edge on the right stocks to be considering. WBD, Warner Brothers Discovery. Look at this one popping today on the daily chart. up 1.15%. I like this one. And here it is on the weekly if you want to see what that looks like. Very bullish chart overall. It's kind of like stalling a little bit right here, though. It is stalling. Maybe giving some time for the moving average to catch up. But it's overall very strong trend. ADX is still moving up. I like it. XBI, which is the biotech ETF, has been on a run here. That's the weekly chart, and here is the daily. All looking good, even though it was down 0.93%. XLF is looking good. That's the financial ETF. I like this one a lot. Here's a perfect example of what I'm talking about. So here's that consolidation. Okay. An very long period of time. This is from July. Okay. Look right here, July 2025. Okay. It was just kind of stuck in this range forever. And now the financials, as you can see, on this candle, broke above that 54.49 level. What happened? It moved up slightly, came back, and now retested that 54.49 right there. Not once, but 4 times before bouncing. So like I said, what is previously resistance, right? You can see how many times price came to that level from, it came back to that once, twice, 3 times almost, and then got rejected. It didn't get rejected this time. Now the buyers took control. Okay, the price of the CTF, the financials should be going up. So that the character that was talking about, not liking financials, I think he's wrong here, completely wrong. The guy in the last segment of Closing Bell, financials have been stuck forever. Well, at least this ETF has. Okay, the XLF. All right, industrials, XLI. Let's look at this one. Here's another one that's kind of still consolidating as far as I'm concerned. This one did break through, but sometimes you'll have a failed breakout. This was a failed breakout. If we look at the candle, let's go down further and let's investigate a little bit. What was going on here? Now, the directional movement index was very bullish. Okay, if we look straight down, we get the green above the red line, and we get the ADX moving up. Let's go down even further. Sorry, that was my Google thing. I gotta pause that for a second. Hold on. Google's always listening, so I had to lower the volume on my phone. Anyway, let's get back to what we were just talking about. Okay, so here is the candle, the breakout candle. Now let's take a look at that. Let's go all the way down and let's look at the volume bar. Do you see that right there? Do you see how it's a red bar? That's kind of a signal right there. That is not a positive signal. It also wasn't significantly high like these other candles here. And you can see that volume just dried out, okay? And then it's come back to that 156.99 level and now finding resistance once again, isn't it? For 2 days in a row. So industrials I'd be more concerned about versus financials. Does it still get the blue flag? It does, because price is technically above the Tengen-sen and the Kijun-sen, the green line and the red line, and the cloud is bullish. Chiku span here, the white line is above price on both the daily and the weekly chart. But on the daily chart, it just looks a little bit not as strong as the financials. So that's something to pay attention to. Not just the Ichimoku indicator, but also price action and how is it performing when it breaks through levels of resistance. Now, the rest of these, folks, okay, the rest of these, and there's a bunch. All right, all these there's something off. There's something off technically, and so let's look through these real quick. The daily chart, it's under the Tengen-sen, it's under the Kijun-sen. This is something that you don't want to consider at this particular time. It's still in a technically pretty strong uptrend, but it could potentially drop through the cloud. It's found weakness here because price didn't continue moving up. The sellers took control. The sellers are currently in control to some extent because, as you can see, we also got a negative crossover, the green line crossing under the red line. All right. Now the cloud is still intact with the Senkou span A above Senkou span B. But if you notice the Chiku span, remember we also talked about that lagging line, that white line there. If you look at it, here it is. It's currently like right under the candle. So like what I said before. So we've got a couple of things going bad here for APA. So stay out of APA for the time being. It might turn around, all right? Because the weekly chart, the weekly chart is still strong. Let's take a look at that weekly. Oh, I take that back. It's not. It is not strong. All right. So the cloud, it's above the cloud. It's still in a strong uptrend on the weekly if you look at it overall. I mean, it's not terrible, obviously, because it broke through the cloud, and that's really the initial beginning stages of when you want to start thinking about buying the stock, is when it starts getting above the cloud and also passes all the other tests, right? Because APA has been in a decline for a while. I mean, think about it. What if you had bought this stock, for example, I don't know, maybe you thought that it had dropped quite a bit, because from this price here of $50, it had dropped down to $30, and you would have said, hey, you know what? I'm going to buy it here because it's cheaper. 4.1 months later, that was a 37% drop. But if you did, okay, yeah, you can see that it did move up briefly, but then it dropped, right? It continued to drop. And from this level, hypothetically, it's down another 23.29%. But right now, we've also broken through a resistance level. This trend line has been broken, okay? But there are more resistance levels here. You can see there's another trend line right there waiting. So once you get up to that 200-day moving average on the weekly, that's going to be a level to watch out for. Anyway, you get the gist of it. So right now, I'd hold off on APA, obviously. Alibaba. So anything that's under the cloud or inside the cloud, I would skip. Okay, that's a time saver for you, really. So you skip Alibaba. As you can see, it's under the Ichimoku cloud. That's bearish. CBOE, Global Markets Inc. Next earnings, February 6th. Profit margin on this one is 21.29%. The price of sales is 5.56. You can see sales growth is up 5.51. It was up 0.98% today. This one, the price is above the cloud. It's above the moving averages. The problem with this one is, as you can see, the Chiku span is underpriced, the white line, and we had a negative crossover. So I'd skip CBOE for the time being. It might turn around soon. Cisco, you can put it on your watch list, for example, if you're interested in it. Cisco is under the two moving averages. I'd hold off on that one too. Okay. CSX, which is the industrial sector's railroads, pulling back, staying under the Tenkan-sen. Right now, it's kind of building this little base here that you can see, right? Kind of stuck in there. If it gets above the Tenkan-sen, that will be a nice buy signal, but it's not there yet. Dominion Energy is under the cloud. I'd skip Dominion. That's ticker symbol D. KRE, the regional banking ETF. What's going on with this one? Why did this not get the blue flag? Well, you can see today, it was above yesterday, but today it's under the 9 period. This one here it's likely that it could certainly break back above. It's kind of consolidating, building a base. So what I would do in this scenario is probably wait for it to break above these highs here, just to get that extra confirmation for the KRE. All right, we'll see what happens with KRE. MCHI, that's China Index Fund. It's in a decline. I mean, it's from the highs up here. Okay, this is from Thursday, October 2nd, 2025. It's down 10.3%. If you want to be jumping in while this thing is still in an embedded downtrend, in a declining, a downward channel, you're playing with fire basically in that scenario. And I understand, like I said, people want to try to pick the bottoms, but it's really tough to. Wait for price to break above the cloud. Wait for that momentum to change to the upside, and then you'll have a higher success ratio. Netflix. Also, not the time to be jumping in here either. From the highs back on June, it's dropped 30.34% and it is still declining. Okay, still under the moving averages. This is a very bearish chart. Why? You got Senkou Span A under the Senkou Span B. You've got price under the Tenkan-sen and under the Kijun-sen. And as you can see here, the green line is under the red line. You've got price under the 200-day moving average, right? And you've got the Chiku span here under price. All of it. All 5 signals are telling you, no, don't do it, right? Wait for some strength to come in. Wait for, the big players are going to, what will happen is at some point, the big players, big money is going to come in and say, you know what, the price has dropped enough now. Let's buy it up. and they're going to help to push and the accumulation to come right back into that stock. It's not happening now. I can tell you that. So the chart will tell us that information. That's the beautiful thing about it. PLD, Prologis, Inc., still moving up, but it's under the Tenkan-sen still. All right, that's the only negative here. All right, let's look at the weekly chart. Still very bullish on the weekly overall. All right. This one has been consolidating for a while though too. You may want to hold off on this one. It's not a chart that I think is a pretty chart. When I see the cloud itself crisscrossing all over the place like this one is, you can see here, right? It's just, this is what's happening with the cloud. I don't like that type of chart. I want to see consistency. I want to see it moving up, okay? I'll show you an example of that in a second if we see one. Paramount Skydance Corporation, Class B. Okay, this one was introduced on August 8th, 2025, that week ending August 8th. And since then, it's up about 28.63%, but you can see it's in a decline right now. I'd stay out of that one. That's the weekly chart. Here's the daily, right? It had an initial jump, right? It reached a price of around $20.98, and it's already down $13 to $13.54. TOST, I'd stay out of that one, obviously. I know Josh Brown likes this stock, but yeah, look where it's stalling, right at the cloud itself. And so as long as it's embedded under there, I'd stay out of it. It's under the 200 as well. Uber, in a decline, downward channel, obviously. Very clear to see, right? Very clear to see, downward channel. No, on Uber at the time, for this time. XLB, materials ETF. Okay, this one on the daily chart is emerging above the cloud. This is the beginning. This is what you're looking for. You're looking for price to be emerging, breaking above, single span A turning bullish, right? Crossing above that single span B. Price above the 200-day, the dotted yellow line that you see right there, and it's moving up. And you get a series of higher highs and higher lows. The problem is, you don't have it on both time frames, I'm going to guess, because it's been in this decline for a while. Let's look at the weekly chart, because the daily chart looks great. But again, if the weekly doesn't confirm it, I'm going to skip that one too. Now, XLB is an ETF. The materials sector, when I do the analysis, it's a different group that I'm looking at. XLB, okay, is a very small group of stocks. Let's see, it's about 26. All right. Now, when I do my analysis this coming weekend, we're not going to be looking at just this is not a good representation, okay, of the materials sector. So here's what I'd be looking at. Let me show you. We would be looking at the SX10. Now, this is a proprietary symbol for TC2000, the software that I use. Why is this more significant than the XLB, which looks terrible? The reason it's more significant is because if you look down below, let me just go ahead and show you guys something. So under basic materials, okay, you'll see these are the industries that pop up. Okay, you got aluminum, copper, gold, industrials, metals. All right, tons of industries. And once I select one of these, let's say I select aluminum, all right, it will show you what specific stocks fall up under aluminum, okay, right there. Now, if I just select basic materials, let's see how many total, there's 329 stocks that it's looking through. Do you see that there? Okay, so that's what I'm talking about. 329 stocks right there. That's a better representation. And by the way, I do that for all the sectors. So that's why you should consider becoming a member. You get more information that they don't talk about on the halftime report or closing bell. They're entertaining, but they're not going to give you the information that you need probably for if you're planning on investing and you want to have a better sense of where each sector and industry is, okay? So that's what we've got there. So we were just talking about XLB. Let me go back to it here. Where were we? Yeah, we were right there, XLB. Now, if we look at this on the daily, it looks like that. On the weekly chart, you know, it's also you get Tenkan-sen under the Kijun-sen, so that's the one negative right there. Why it didn't pass the test. All right, APA is another stock they talked about. Energy sector, oil and gas. Oil and gas has been building up here. You can see that it's in an upward trajectory right now. It's above the cloud. on the weekly, but it's under the Tengensen, the 9 period. So I'd hold off on that. Here's the daily chart under the moving averages. And didn't we already do this? Netflix? Yeah, we did these. I think I changed the order accidentally. Anyway, yeah, Netflix obviously down. Okay, let's get into the Mag 7s, folks. Here's Tesla, down 0.66% today. Stalling once again at a monthly level. Now that 488.54, it's color-coded purple. Let me show you why, because I like to know exactly where we are on resistance levels. And here's the prior candle from December 31st of 2024. That's the monthly candle for December 31st, 2024. 488, okay. 54 was the high of that candle, and we are currently under it. All right, we're currently at 485.69. It's moving up slightly, but this could pull back. There's no guarantees here with Tesla. Here's the weekly chart. It's stalling. Overall, it looks like a pretty bullish chart on the weekly, but it needs to prove itself this week. We'll see what happens. Apple. So it did still get the blue flag, but I would hold off on buying Tesla at this time. Apple is pulling back. It's under the Tengensen, under the Kijun-sen. You can see that right there. Overall, it's in a strong uptrend on the daily. Meta is inside the cloud and under the 200. So no on Meta, obviously. It's in a downward channel. We got Microsoft under the cloud. No on Microsoft, at least for the time being. It's a great company, but not the time to be jumping in. Amazon under the cloud as well. So no on Amazon. Okay. Then we've got one stock we're going to look at from one of our members, TTAN Service Titan Inc. on the weekly chart. All right, it's inside the Ichimoku cloud right now. So it looks like it did get above it. You can see that the upper wick there, it did pop above the cloud. That represents the high of the week, but then it retracted back into the cloud itself. So that's not, it's not giving us a buy signal here yet. We also have the Tengensen under the Kijun-sen still on the weekly, but we do have a Chiku span that's above the candle. So we've got a mixture of things happening. We don't have confirmation from all the indicators, okay? The cloud itself is bearish. If you look at the daily chart, it looks a lot more bullish. So again, it's up to each trader to determine their risk tolerance. If you want to jump in on a daily chart only, just recognize that it has a higher probability of pulling back, all right, because of the resistance where it's at right now. And let's see, what else was I going to tell you guys? Oh yeah, something that can help you with understanding these candlesticks too, the Japanese candlesticks, is I have a Twitter page as well, x.com. If you go to x.com, you can find me under @BlueCloudTrader. That's the screen name. If you scroll down a little bit, you'll find posts that I place, including some of the videos and everything else. But you will also, under highlights, there's multiple tabs here. You click on the highlights, and if you scroll down a little bit more, scroll down, there it is, the candle pattern reference sheet. This is it's like a cheat sheet that you can use to help you understand what's going on with the candles. And like I said earlier, it shows you what the wick at the top of each candle represents. It's the high of the day, the low of the day. Whether it's a negative day or a positive day, the high and the low remain equal. How do we know that? How do we know where the opening price is? If it's a green candle, the opening price is at the bottom, okay, and it moved up throughout the day and closed at at whatever price level that ends up being, if this was a daily chart. If it's a red candle, the opening price is the body at the top right here, and this is where it might have moved up in the early part of the morning, then dropped all the way down to this level, but then finally closed here. That's the closing price. So that's understanding the Japanese candlesticks. And then when you take the patterns over here, you got single candle patterns, like the bearish spinning top that you might have heard of. You've got double candle patterns, like the bearish engulfing or the bullish engulfing. So you got bullish patterns here, bearish patterns over here. If you memorize these, It will help your trading quite a bit. You'll have a higher probability trade, basically. So you might avoid, adding a position. For example, if price has been moving up and you see a hanging man at the top, or a shooting star at the top, or a gravestone doji, as they call it, or a bearish spinning top after a move up, that's all bearish. Now, those same exact candles, if you see them at the bottom of a move, can be very bullish. Okay? And there's some more patterns right there that you can check out. Anyway, guys, thanks for watching. Thanks for supporting my channel. And don't forget to like, subscribe, and throw in a comment if you like. Okay? And I'll catch you all in the next video.